Hey there, haven't done a video update in a while, so thought it would be good. A few things to talk about. I'll try to make it as quickly as I can. This week we had the Federal Reserve meeting. As expected, the board voted to lower the federal funds rate by a quarter point. Again, has no bearing on mortgage rates. But what happened right when Chairman Powell started talking? Mortgage rates ticked up a little bit. That was to be expected. Locked in a couple of people beforehand because we knew it would tick up a little bit. The good thing is now we've seen it kind of correct a tiny bit and also flatten out, which is great. Real quick summary of the actual Federal Reserve meeting. Again, like I said, they cut inflation progress, but not victory yet. That's good. We want them to keep fighting inflation. Obviously, that's should be their priority more than anything else. Really should. They are a little bit concerned with employment. I think that's over. I don't think that really should be their concern. They just need to get inflation under control. It's not their. I don't think it should be their concern to mess with or want to play a factor in employment. That's something the private sector will take care of on their own if you create good conditions, right? And I think that part of the problem right now is we're seeing slower job creation and or job growth is just because things are getting more efficient. Obviously, AI is taking over. There's a lot of tasks that are being automated. Overtaxed states are giving businesses the incentive to be more efficient. And of course, like I said, AI is kind of taking over a lot of tasks and whatnot. I think that what we're seeing is a lot of if people are retiring or leaving jobs and they are not refilling them. Also, one of the things that people aren't really talking about is there's also a lot of people who are going back to work full time or finding full-time employment and they are leaving their part-time jobs. So that's like a net decrease. If you leave two part-time jobs and go to one full-time job, then that's actually a minus one job. That's how they look at it. They don't care about it being better that you have, one full-time job now. So that doesn't really get, shared in the numbers a lot of times. But one of the biggest parts of the actual speech was that they are saying that quantitative tightening is going to be paused. Now, here's what these are. Quantitative easing is what happened during COVID, and which is one of the reasons why rates tanked the way they did. But quantitative easing is when the Federal Reserve was buying treasuries and mortgage-backed securities. So they're buying a lot of debt, also contributed to some of the inflation as well. But that's one of the reasons why rates went down so much is because they were buying. Whenever you buy bonds, rates go down. So they were a buyer in the market, which they really shouldn't have been. So that was one of the reasons why rates went down. Now, over the last couple of years, because their balance sheet was so loaded with all of these things, with mortgages and treasuries, is they were doing quantitative tightening, which means they were letting them run off their balance sheet. So as they were maturing, they were not rebuying or they were selling off. If there were buyers for those, they were selling off what they had. And so that's also kind of kept rates a little bit higher as well. And so they're pausing that. So what that means is they're not going to buy they're not going to, as they're running off their balance sheet, they're not going to just be done with it. They are most likely going to repurchase bonds with those funds that are being opened back up again. So before they're just letting them run off, right? So now they're going to repurchase what becomes available again, but they're not going to purchase extra. They're not going to go back into easing, right? So they're going to have more of a neutral stance, which that could possibly help us on the long-term rate forefront, which could be good. So look for that to maybe help a little bit. So that's kind of a good news for us. I think that's what they need to do is to get back into a neutral stance. Maybe then, as if inflation keeps coming down, then they can run more, get back into tightening and run some more stuff off their balance sheets. Now, let's look at the market itself. Okay, so here is we are pricing right now. We're in the green today, which is great. Just a little, it's just kind of holding flat. Now, this is a 10-year treasury yield, which is my favorite barometer, as you all know. And this was right here. They announced the decision. Yeah, it's all normal. And then right here is when Chairman Powell started talking. Every time, everything goes up right when he starts talking. So he really just needs to shut up, and that would help everybody out, I think. So, but he started talking. Rates kind of jumped a little bit, and this looks really bad. Oh man, oh crap! And we're not really talking about a big spike. It looks bad here because this right here is just the last 5 days, and it just spiked right when he talked. But that was really only about 0.1%. So mortgage rates went up by from like 6 point, like the average daily rate went from like 6.2 to 6.3. That's basically what happened. It's not a big worry. So here's a month. Here we go. Going back a month, we see we're still a tiny bit lower than where we were about a month ago. And then obviously this is 6 months ago. And as you can see, we are lower than we were 6 months ago. So the trend has been down, which is great. And of course, this is how it works. Like we have little peaks and valleys, right? But the overall, so down and then up a little bit and then back down. And so the overall trend has been downward over the last 6 months, which is good. That's what we want to see. I think that the market is getting back to a more stable position. And I think that if not for the wrong fears around tariffs, then we might see things a little bit lower. But I think the market has been a little hesitant because people are wrongly thinking that tariffs cause inflation, which they do not. A tariff is not devaluing of the dollar, it is a one time cost increase to a product if it is shipped from overseas, right? It's a tax at the point of entry. It's not inflation. It's not devaluing of the dollar. So, and that only happens once. So now, one of the things that has me a little bit optimistic, and I think optimism for me is just if we're in a more stable spot, is the mortgage spreads are the main thing to look at. Inflation has been fairly flat for a while, the mid twos, and rates are not going to go down anymore unless inflation continues to go down. But the good thing is that the spread between the 10-year treasury yield and the average mortgage rate is a little bit bigger than normal. And what I mean by that is right now you see the 10-year treasury yield is trading at 4.09. And typically the average 30-year fixed mortgage rate or conventional rate is about 1.75 to 2% higher than the 10-year treasury yield. So even if it's at 2% higher, that would put the average mortgage rate at 6.1, 6.09, right? But in reality, and here we go. Here's our average mortgage rates. Here's this handsome guy right there. Right here, you see 6.28, right? So it's about 0.2% higher than what usually the highest spread usually is, right? So if we were at a 2% spread, then the average mortgage rate should be at 6.09, right? But right now we're at 6.28 for an average 30-year fix. It's just a general mortgage lending survey. Mine is always about a quarter point lower than what the average is. So that's what gives me some optimism moving forward, is that even if inflation kind of holds, which that would be good for us. Obviously, we want it to be lower. And even if the 10-year treasury yield holds as well, we could see mortgage rates tick down another quarter point, maybe about 3/8 over the next couple of months, just as the spread tightens back up to historical standards. So I think that's what we really should be hoping for. Now, for clients who are looking for houses right now, a quarter point is not going to make or break you. It's not worth waiting for, especially if the right house comes along. So, we definitely want to encourage them to go ahead and purchase. Like I said, I'm already a quarter point lower than at least a quarter point lower than most everybody else out there anyway. So, so if they're pre-approved with some big national lender or a bank or something like that, I'm going to be lower than them anyway. So there's value there, but it's definitely not worth waiting. And then if we get back into a more active market, which I'm thinking that's possible, what could happen as we do get closer to that 6% mark on the average rate. So if you need anything at all, let me know. But these are the kind of what has happened this week. And looking at moving forward, we are not going to have any more data dumps because of the government shutdown. And so that's another thing to be encouraging, that's another thing that we should really spur our clients on, is that whenever they do reopen the government, I wouldn't be surprised if there's a little bit of an excitement shock there and the markets pick back up and are really excited again. And then we see mortgage rates kind of adjust up a little bit real quick. So anyone who is looking right now, it's a really good opportunity to take advantage. Any of your past clients who have VA over 6.25 or conventional over 6.75 is good opportunity to look at a refinance right now. So they may not be right, but it's at least a good opportunity to look at it. So if you have any clients that purchased over the last 3 years and they could see they could use some savings, then we can have a conversation. And if it's the right time, great. If not, at least we can put a plan together. I'm never going to force anybody to to go into a refi. I don't want costs to outweigh the benefit. So, but if we can do anything to help clients at all, provide value, we are here. Thank you. Bye.